Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome. Commercial Real Estate Pro Network's CREPN Radio. We're so glad you joined us. My name is J. Darren Gross. I'm a real estate investor and a commercial property insurance broker. I've been an insurance broker for 25 plus years, and my primary client base is and has been real estate professionals, investors, landlords, property managers, developers, design professionals, and lenders. Based on this, I'm continually looking for more information about real estate investing for both my own investments as well as to better serve my clients. The result of this has led to the creation of Commercial Real Estate Pro Network and CREPN Radio. Our goal is to have and share in a conversation with experts on topics of interest to commercial real estate professionals and investors. You can find us if you go to your search engine or your Google and Google Commercial Real Estate Pro Network. We've got a Facebook page, we've got a YouTube channel, LinkedIn group. If you're on LinkedIn, I can't stress enough to consider joining the LinkedIn group. It's, again, Commercial Real Estate Pro Network. In the group, you'll find discussions on deals. There's professionals constantly offering up topics of information that make sense, lenders, CPAs, attorneys, etc. So check that out. Also, we've got our Twitter handle. It's at CRE Pro Network. And also you can find us on iTunes under Commercial Real Estate Pro Network. And most recently, we've also got a website. There's not a lot there just yet, but more is coming soon, and that's commercialrealestateProNetwork.com. How you can help is if you like what you hear, we'd love to hear from you. You can like, share, follow, post what you hear, the show in your network, and that'd be a big favor. We'd love to hear from you, like I said. So now that you know a little bit about us, what we're all about, it's time to set up today's program. Now, there's a couple of L's in real estate, the L of location, and then there's also the L of leverage. And leverage is that which allows you to buy something more expensive than you have resources directly to use your own resources. And our guest today is a real estate professional who will shed some light on the current marketplace, lending requirements and opportunities for borrowers to improve their current situation or get cash out of their property. And also he has a tool that he's made available for our listeners to download, and he'll tell you a little bit more about that. But first, let's welcome our guest. Our guest is Darryl Dahlen. He's president of Global Solutions. And Darryl, welcome to the program.
Hi, good morning. Thank you for having me. Appreciate it.
You got it. Darryl, I'm just curious. I know you're on the East Coast. I can't remember, is it Maine or Rhode Island? Whereabouts are you?
Southern Maine. Like
Southern
a lot
Maine?
of states, there's different. Every state has its characteristics, and I'm in Southern Maine, right next to Portsmouth, New Hampshire, and about 40 minutes from Boston.
Got it. Well, we're so glad you are making some time for us today, and we really appreciate that.
Sure.
And before we get going here, maybe you could shed a little light on your background, how you got your start in real estate lending, and how you arrived at Global Solutions.
Yeah, sure. I'd be happy to. It's been a little bit of a journey to get to where I'm at. I'm a veteran. Joined the Army out of high school, and was in the military for 4 years during the first Gulf War, and had the privilege of attending language school for the military, and then later on, towards the end of my first enlistment, I was at Fort Bragg and suffered a parachuting accident, so that held my Army career to the period of 4 years, and then I consequently went into college at the University of Southern Maine, where I studied biology and had aspirations of becoming a physician assistant, And what I ended up doing in reality is opening a bar, because what I was doing in college was working in the bar business and progressed in that field. And to me, it just for where I was at, I just felt like I had more of a opportunity and inclination towards that business. So I was in the bar business for a number of years, and then for a lot of people that have been in that business, could tell you give up a lot. And after a number of years, I was ready to sort of reclaim my life back. And this is back about 10 years ago. The real estate business was on the upswing, and seemed like everybody and their brother was getting into the mortgage origination field. So I happened to know somebody that owned a shop that was a customer, and when he knew that I was ready to get out of the business, said, "Why don't you come work for me?" So I did, and that was how my transition from the military to college to the hospitality business to finance became a reality. And what happened early on in the mortgage business is I had a client who I did a refinance for in their home that owned a commercial business, and asked me if I could help them. And back in that point in time, there was a couple lenders that you could submit loans to, and essentially they would do all the work, and they were geared towards residential loan officers to be able to also originate commercial loans. So he was my introduction into commercial lending. I took the bait, hook, line, and sinker, and decided that that's really what I wanted to pursue, and that's how I got into commercial real estate financing.
Well, it's quite a journey. I've never heard anybody talking about how they woke up and just started out and stayed with it. It's an interesting story, and you get there how you get there.
Exactly.
I'm curious. So you started off doing residential. You got into commercial. Mm-hmm. How did you end up at Global Solutions? And if I understand right, you're the president of Global Solutions, correct?
Correct. Yeah. It's one of those things that I think you for a lot of people, you're sort of born with that entrepreneurial spirit, and that's why when I started working in a bar, I always, it's kind of been the frame of mind that try to be the best and ultimately be the owner of an establishment. So I've leaned towards owning a business, running a business, more than just being an employee of one. So when I got into commercial lending, from residential lending, it was a long road to hoe, just because of the learning curve. Residential and commercial lending share some similarities, but the honest truth of it is they're more dissimilar than similar. But I was thrown into the deep end of the pool and took on a management role in the company I was working for, and worked my way up through, and then just branched off on my own when I came I was running a company out in Las Vegas, and then when that ended, just because more of the capital markets and the shifts, and this is right when the economy was on a downslide, and Las Vegas bore the brunt of that. So it was no longer really the company dissolved. So I came out here, shifted everything around to where I'm at now, the focus that we focus on, and started at Global Solutions.
Gotcha. No, it's an interesting ride from just the market swings. I saw in the Wall Street Journal the front page today. They're already talking about when's the next collapse going to happen.
Yeah.
It's it's never good. It's got to be either amazing or just horrible. It's I don't know if that's just all newspapers or.
When I got into commercial lending was right when the market started to teeter, and when it collapsed, I think we all can remember it. It happened fast, and really no no asset class was safe in commercial lending, and even in the residential world. I mean, banks and lenders were going out of business on a daily basis. So I got into commercial lending at the absolute wrong time. But even on the residential side, there wasn't like that was a prosperous time to be in the residential real estate sector either. So I just hung with it. I didn't want to hit the reset button and go to any other field. I felt that it was a matter of time, and that like anything that you do for yourself, you're going to hit bumps and have hurdles. And if you're always heading for the door when there's a challenge, you're always going to be starting over. So I stuck with it. It's paid off, but it's been a long road for sure. But it's been worth it.
Well, that's always a fascinating story when you hear about people's success, and you mentioned just the staying with it. And I think so often everybody's swayed by the emotion of the herd. If everybody's leaving the party, why are you coming to the party? I mean, it's
sure.
And actually, in reality, that's exactly the time to show up, because and leave before, and don't stay too long. I mean, if you're trying to time the market,
right?
But no, I would say that you probably are exactly the prototype. If you arrived at that point and everybody else is leaving, that's exactly the point to kind of cut your chops and really kind of establish yourself, so that people that are, because clearly the investors and the owners of real estate are still in need of financing, and probably even more so in a tough market. If you're with a building that's running vacant or in transition, and you need to secure some solid financing. So,
well said. As far as when I made that transition, now I can say, looking back, it was a good time if you have just the wherewithal and the means to tough it out, because if we've learned anything in real estate, is that when there's a void, people will eventually come to fill that void, and it allowed me the opportunity to sort of, in some cases, be in on the groundwork where some of these lenders were coming to market and developing new products, and as things started to improve, be the first that were doing what they were doing. And now there are, other lenders out there doing it. But it allowed me to develop the connections, the network of new lenders, oftentimes with people that had transitioned from other lenders, because that's just how it is in this business. People move from lender to lender, job to job, as things develop. So the relationships I have, in a lot of cases, are with people I've known for many, many, many years, but they are now with new lenders, and that's really kind of opened the door for me to be able to be successful. With lenders that I probably may not have learned of, and still may not have known of, because a lot of these lenders, while they're large, they're not necessarily well known or easy to find like a Wells Fargo is. It's on every corner. So
right.
It worked. It worked by persevering.
No, agreed. So before we jump into our kind of our discussion, I wanted to let the listeners know a little bit about the giveaway that you provided, the worksheet kind of tool thing. Can you tell us a little bit about what that is, and we'll tell them how to get that?
Sure. So it's an Excel spreadsheet that I use to really quickly analyze a deal from a financial perspective. So you can input the income of a property, doesn't really matter what it is, in there along with the expenses, and it'll spit out what the debt service coverage ratio is, or debt yield. A lot of lenders are moving towards a debt yield analysis more so than a debt service coverage ratio. And you can adjust the amortization and rate so that you kind of have a good feel for do the financials support the loan amount that you're looking for based on the terms of the loan that you're seeking. So it's not it doesn't give you every opportunity to use interest only, things like that. It's a little on the rudimentary basis, but it's proved invaluable as far as just getting a quick look to see if the numbers work from the macro level, and see if the loan amount based on the lender that I'm thinking of using can work.
Sure. Well, I tell you, just as an insurance broker and constantly working with clients and needing rent rolls, et cetera, I can't tell you how many times I've gotten chicken scratch on napkins as rent rolls kind of thing, and just from a very basic format that allows them to list the tenant and the rent and get some sort of a global sense of what they have. And it's something that's in a presentation form that you can present it to others and they won't have to decipher, is that an L or an E or
right. Yeah.
What is this? So I think it's a great little tool, and I'd encourage anybody who's listening to check it out. There's a link on the show description you can click on to get that, and you'll get that. And please check it out, use it, and if you have any questions about it, I've got Darryl's contact information on there as well. But anyway, let's get into kind of more of our discussion now that we've kind of got our little introduction kind of stuff out of the way. What led me to reach out to Darryl was there was a post in a Facebook group, the group called Commercial Real Estate Network, and it was posted by one of your associates, Marie Fleming. Mm-hmm. And I'm going to read it here quick because I think it speaks volumes to what I saw as like, wow, this is really outside of the box. And I say outside of the box. We'll let you describe and kind of go into it more, but I just want to read here kind of what it said. It said, commercial loan closing from Global Solutions. There was an $8.5 million refi on a 416-unit multifamily in Houston, Texas. We're pleased to announce the recent closing of a repeat client. This property is owned by a foreign investment group who were looking for a cash-out refinance to distribute some of the equity to in the property back to the ownership. Despite a lack of historical financials, we secured a loan using one of our CMBS lenders who looks more at the current cash flow. This lender also allows for unrestricted cash-out requests and is willing to lend to foreigners. The terms of the loan were in the low fives. It was a 10-year note with a 30-year amortization schedule. There was a 4-year interest-only introductory period. $4 million in cash-out proceeds. It was a non-recourse loan. Mm-hmm. The it provided funds for some minor repairs. Not one of the 102 owners signed for the loan. We used the asset manager as the sole guarantor. Says this is a perfect example of how matching a loan with the right lender really matters and how we can assist our clients to secure fantastic terms that no brick or mortar bank could ever offer. Mm-hmm. That's there's a lot in there.
Yeah.
And it caught my attention. And I guess my first thing, is this a standard deal for you guys, or is this kind of an outlier, for opportunity for you?
Sure. No, it's there's a lot there. I'm glad it caught your attention because that's ultimately the goal. When we have closings like that, they can almost market themselves because the hope is that what we do is attention worthy. I believe it is because, like you said, there's a lot there in one loan. I think just by offering, say, the $4 million in cash out, alone would grab people's attention. But to answer your question, that's a lot of what we do is that type of financing. Now, that's a lot of money back, given that the first on that loan was $4.5 million. So that's almost doubling the debt with half of it being cash. So part of the niche that we've created here is, I don't want to say out of the box type lending. Certainly, I think that probably, I don't really like that term, but it probably fits in this particular case, is being able to offer that type of financing to our clients. And what we've done is sort of seek those type of clients out because it sets us apart. While I would like to be able to do vanilla loans all day long, I guess the truth is that banks are doing vanilla lending, and I don't want to compete with the bank as a matter of day-to-day operations. I'm a small outfit, and my name recognition does not match that of a large brick and mortar bank. So I don't really want that as a competition. So as a matter of setting ourselves apart, it's trying to find lenders that allow us to provide a service, and in cases like this, it's a tremendous service because, like I said, said in that marketing, no brick and mortar bank would entertain something like that on multiple levels. So, yeah, we do a lot of loans like that. We certainly do some cookie cutter type agency financing, small balance commercial, bank based financing, but percentage-wise, I would say that's loans that are probably fall in that outside the box category comprise about 85% of what we do here. So it's not a one-off. I mean, it's probably the easiest way to say it, and that's not one-off financing. We do it on a regular basis.
Well, that's encouraging because I know sometimes
Yeah.
you see these things and it was an absolute miracle, kind of rabbit out of the hat, and it can't be repeated, and it just caught the underwriter on a good day.
And some people they get lucky, they get the large amount of cash out. They don't have strong historical financials, so they're looking for good terms. That can be an objection with a lot of lenders that especially the more brick and mortar type, they like seeing the historical financials or the non-recourse. I mean, it's more common than it used to be, but good luck getting that from, say, Wells Fargo or some of these other banks. So the interest only teaser period, the fact that none of the owners signed, that's
the one right there. I think would get everybody's attention.
Yeah, no doubt it will. So we've done that on this investment group. They own quite a few properties in the Texas market, and every single one of them, I think we've probably done 6 loans for them now. Not one of them has signed on a loan or provided one document, not even a personal financial statement. So, that said, we've used the same lender for all of these deals. They're all CMBS loans, but that does not mean that the CMBS lending now encompasses quite a wide array of programs and types of loans. It used to be, I think, that the CMBS lending was more of a tier 1 type borrower in property, and now with capital markets such as they are, there are CMBS lenders that are doing some more off-color type loans, and the particular lender that we use for these, I think is a bit of a niche. These are one of these lenders that, like I said, they're not hard to find, but I don't think for a typical borrower they would find them and or be able to discern that this type of loans available through them. So it's really given us the ability to perform, help our borrowers, and get loans closed that otherwise most other lenders wouldn't entertain, or if they did, wouldn't provide all of these components that we've been able to do.
A couple other questions about the deal. Class of property, is it A, B, C? What was it?
Yeah, for most of what we do, they're Class C properties. We generally work with investors who are in the value add space. that's that's where a lot of these people want to be, because the investors that are buying and taking down Class A and B properties. I'm not trying to say this to be negative, but generally those types of entities are a little bit more sophisticated than somebody that's maybe just kind of starting out and buying value adds. It's a different mindset. If you're buying a Class B, your price point per unit, and you're just spending more money. Those tend to be investors that are better. They have more money behind them,
right.
Large portfolios. They're generally all set with regards to their financing, lenders. So they don't need somebody like myself. So most of what we do is Class C properties. We don't really go into anything lower. Even a lower Class C can be problematic. But that's really where a lot of the activity is people looking to buy Class C, and either for a short-term hold or medium. And we're starting to get into people are reevaluating their position and holding Class C, just because a lot of the low-hanging fruit's been picked over. But almost everything we do is Class C.
Got it. And how long had the owners owned this property prior to refinancing?
Yeah, they bought it in 2012, but the property languished due to bad property management. So they had taken on quite a few properties and using the same manager and all value add opportunities, and they just in this particular property, like some others, the property suffered because of lack of management. And when they got rid of that particular property manager, there was probably about a year or a year and a half where there really wasn't much done. It was just treading water, wasn't performing well. So when my client, who is he's an owner operator in his own right, but he has become the acting manager for this investment group. So when he took over the property about a year ago and started giving it active, proactive management, and things started turning around as far as the cash flow, the occupancy, that's when the financials started coming, looking more attractive, but it was only about the past 6 months it was operating in the black. So even though they owned it since 2012, it was only until about 2015 where really the financials started looking good as far as being able to service not only the existing debt of $4.5 million, but to be able to service even higher debt. So a lot of what we do here is story-based lending, whereas say a bank is going to look at historical financials and want to see tax returns and see 2 or 3 years. What we do a lot is story-based lending, where the historicals may not look good, and really in some cases you only have year-to-date financials that look good. Now, that's not what we want to see on a regular basis. It certainly makes our job difficult, but we've been able to perform with a good story that it makes sense. Now, that's key to a lot of this. You can't have bad financials because of bad ownership and management, but when they're coming around, and we can use the year-to-date financials or pro forma to really solidify that story.
Another question, or a couple of questions I want to run to. The out-of-country investors, how much of a challenge is that? I've had numerous contacts, many of which were scams.
Sure.
You get the internet's full of opportunity and opportunists.
Yeah.
And how big of a challenge is that for you?
It's not that big of a challenge if you have the right lender. There's a lot of foreign investors coming in and putting significant dollars here in the country. I mean, Canadians, people from South America, Brazil, Europe, Israel, Asia. So there's a lot of money coming in, and that's been coming in for years as far as investors, whether it be single-family residences or multifamily, whatever. I mean, there's almost every single asset class is being bought up by some sort of investment group. So, as far as the financing end of it goes, yeah, I agree with you that you got to tread carefully, but a lot of what's going on with investors, sponsors, they're syndicating those funds. They're looking to buy the property, use other people's money to do it. That's become very popular in the past number of years, and I would say it's about as popular as it's ever been right now. So, as a bank going to be okay with that? I think if that's the outlet that you want to place a loan with, then you might have some trouble with that because they're looking for skin in the game, and they want
Right.
the guarantors to have the skin in the game. Not that they're necessarily adverse to having other investors, but generally if there's going to be 20% more ownership, they want them to be the guarantor, and they don't necessarily they don't, in a lot of cases they don't even like an out-of-state borrower, let alone a foreign
Right.
investor. But it's on the CMBS side, it's not generally an issue as far as if you're using a syndicate of investors, and whether it's American or foreigners. Like I said, we've done about 6 deals for this foreign investment group, and it's not been an issue. Now, we use an American, the asset manager, as a guarantor. It would probably create problems if they wanted to, or one of them wanted to be the guarantor. Not to say that it can't be done, but it would complicate things. But if there's an American sponsor that's using foreign money and they qualify for a CMBS loan, in terms of the dollar amount, the location, and experience, it can be done. It's being done. We're doing it, quite often. It's not easy. You certainly have to. I don't want to make it sound like this is all easy. You have to hit certain hurdles, and with regards to experience, the caliber of the property, leverage is key. We're not maxing out the leverage scale on these properties. So
not to 125% just yet.
Yeah. We get people all the time that want max leverage, and that's very rare these days, that max leverage is being given, even on anything. On the agency side, Freddie, Fannie, and HUD that provide generally the highest leverage out there. That everything's done by the tiering of the market. Is the market a tier 1, 2, or 3? And the highest we've gotten with Freddie is 75%. But by and large, we're not operating in tier 1 markets. Dallas, where a lot of these investment plays are, the value add. You're not really going to find those for the most part, in tier 1 markets. So we're on the CMBS side, we're generally in the 65% loan to value, sometimes 70, but we're not pushing the leverage scale when we're doing these loans that have some hair on it.
Well, and I would hope that recent history or will continue to provide some sort of discipline for the markets to stay at some sort of reasonable levels. I know there's a lot of cash in the marketplace, and it's all looking for a rate of return, and that all by itself continues to bump up pricing. I mean, it's kind of a funny little balancing game. Couple of kind of follow-up questions here. So, in a deal, and I like your term, the story-based lending. I think that's one of the differentiators between somebody that's more of an expert and has a service to provide, as opposed to a click this box, put that number in, and
right.
Congratulations, you're a winner. In that, is there any one thing that matters more? I mean, management, experience, financials, or is it basically just all of it combined so that you can build your story to present it to an underwriter, or how's that?
Yeah, it's all important. It's really all important for the story-based lenders that there are, and there's certainly more now than there were because just competition, and the ones that are having success, the competitors will clone that and come out with their own. But story-based lenders, the true story-based lenders, there's not that many of them out there compared to the traditional lenders that we all know that are really more just black and white. So, but as far as what goes into a story-based loan, it encompasses, generally speaking, all of the parameters to make a good story, because at the end of the day, what it equates is risk, and that's how all lenders are perceiving loans, is just from a risk perspective. So, what goes into story-based loan? It's the background. What happened to the property? What's going on with it? And what a lot of lenders want to know is the property suffering because it's a market issue, it's a property issue, it's a deferred maintenance issue, or is it something that's correctable, like management and ownership? So that's pretty important, and what you want to see that it's correctable. Certainly deferred maintenance and things of that can be fixed, but it's a matter of money at that point in time. But if it's a market issue and or a location, that's not really much you can do about that. So what you want to then see is the experience to turn it around. And do you have the experience? No lender wants to be a guinea pig that you're going to come in and say that you can do it. They want to see that you have done it, so that you need to demonstrate that you have the experience in doing it in the past. Generally speaking, you want to show that you're using a good property management company, somebody that has actual boots on the ground, has a team, they manage existing units, they've done this before. Then the other things, just as far as leverage goes, who the investors are, strength, liquidity, net worth, the things that all lenders really kind of want to see, just to give them some comfort. So, but I guess if you had to prioritize what goes into a story-based lending, it's kind of the background, and then also what's the remedy, and usually the remedy is experience via good property management and historical performance.
Got it. Let's kind of move here from example. I've got some questions just kind of as a kind of more of a market state. Like I said, I read in the paper today, they're talking about the next market crash and how bonds and I think I just skimmed the article, but it's talking about the market. As far as stock market, it's still at about 10%. They thought that if the market rose another 10%, that'd be the time that it would crash. But I think more to it, I guess, how do you see the market? And we can talk about this in kind of some more broader topic or kind of a broader conversation. But the marketplace, is it still full of cash? Do you see interest rates holding? I mean, there's talk at the Fed about raising interest rates, but if there's all this, capital looking for a return, and it's not a lack of capital from what I gather. Do you have any sense of interest rates?
Yeah,
where we're going? Or?
They're up. Rates are going up. They already are. I mean, from loans that I funded, say, just a couple months ago, using the same sort of loan structure with the same lender, rates are higher, and in some cases 0.5%. Rates are going up. Certain things come into play that affect the markets, like what happened in Greece or what is happening in Greece. Those have an impact on rates, but just by and large, we bottomed out and rates have been very low, and they still are. But 0.5% is. Anytime you're talking about that kind of rate adjustment, that has an impact on things. So there's a, I don't want to say a scramble. There's a lot of CMBS loans coming due, but for a lot of them, they were originated when rates were significantly higher, so they're still, realizing a tangible net benefit as far as a lower rate goes. But yeah, rates are not getting any lower. They're always in flux, but as far as where they are now from a month ago versus 2 months ago, they're higher. And that's across the board. It's not just with banks or on the CMBS side. It's even on the agency side. Freddie Mac rolled out a program, the small balance commercial program for properties that fall loan amounts, of $1 to $5 million. And a couple months ago, we closed a loan at 4.2%, and now it's about 4.9%, that same loan. So looking at the rate sheets, so that's a big difference. Still, that's not a bad rate for what you get, but there's a lot of money in the market. That was another thing you mentioned. The capital markets are not drying up. There's lenders that are flush with cash, and I would say the creativity that is now available via lenders loosening the reins, it's increasing. I'm not seeing any constrictions as far as what's available. And that's proof in the pudding. We just that $8.5 million loan, they included $4 million cash out. So it's a good time to borrow money as far as being able to obtain a loan. Lenders are flush with cash, and I think that side's increasing. But rates are on the way up. Lock now.
Yeah, no, I think that's always 0.5% makes a big difference. I mean, who would rather be at 4.2 than 4.9 or 5?
And some of the lower rates. HUD, which is generally more suited for larger deals, you can still get rates in the threes, higher threes, lower fours. So it's not all bad news. And even with Freddie, a lot of it's leverage and the term of the loan. So you can still get really aggressive rates. But I don't want to be doom and gloom. But as far as if you're going to be somebody that's borrowing, at reasonable leverage and want a 10-year term or even longer, Freddie offers a 20, 30, with 10 of that being fixed. Yeah, rates are coming up on some of those programs with some of those options.
You mentioned term and length of term.
Mm-hmm.
I'm curious, what do you see as the average length to maturity when the notes are being called due? Or is there a
almost everything we do is a 1030. That's one of the benefits of using a CMBS lender. We're compared to a bank that might be more prone to issue a 5-year note and come with a 20 or 25-year amortization. There's some banks out there with 30-year AMs, but I wouldn't necessarily say that's the norm. And there's some banks doing 10-year notes, but with the CMBS side, 10 years generally standard with a 30-year AM. A 10-year note with a 30-year AM is kind of the go-to program with a CMBS loan. So you get that advantage. Rates, I guess it really comes down to what you're using, what your goal is. A lot of what we do is not rate driven. Hence, what we offered and the loan that we just funded. We're also offering other important things like non-recourse financing, interest, the availability of interest-only teasers, the ability to finance some deferred maintenance and/or repairs or upgrades. Who can sign on the loan? So it's a lot of what we do. If we're just going rate, some of these lenders that we use may not be the best contender, but we're not really just concerned about rates. For our clients are not all just rate driven. And in a lot of these cases, what we're financing is, even the rates may be a little bit higher, they're still getting a lot more. And the trade-off, sometimes is a little bit higher of a rate versus if you're just going to do a rate and term refinance, and that's all you care about, then that the trade-off is often a better rate.
Right. Well, and I think too, there's a lot to there's the promoted rate, and then there's the actual getting the deal done. And that's part of working with a lender and having relationships, and somebody that has the experience to really
deliver on what they can get you. Banks, nothing wrong with banks. I don't want to be I use banks, but at the end of the day, if there's a particular type of lender that where you might be subjected to changes, it's probably going to be a bank. On the CMBS side and on the agency side, generally speaking, those files are heavily underwritten before you get a term sheet. Sorry, my dog in the background. Those files are heavily underwritten before you get a term sheet. So I can't think of one instance where a loan has differed from the term sheet with a CMBS lender.
Got it. This is a little bit more of kind of a broader one, but are you seeing any? There was something I read here recently. It was just talking about the kind of the increase in values and kind of the pressure on cap rates. Do you see any correlation? Are you seeing? I always thought kind of a cap rate was more of an area, kind of a property class, determinant. But I was reading something about just the basic conditions of the market pushing down on cap rates. Are you seeing any of that?
Yeah, a little bit. I mean, we're not really cap rates as far as we do mostly multifamily here, and generally speaking within certain select markets. So while we operate nationally, we're predominantly in as far as our client base and loans, in the South, Atlanta, in the Texas market, as well as a little smattering of some places like Tennessee. And cap rates haven't really moved a ton as far as the types of properties we're doing in the Class C sector. So I can't really say that's been an impact, on us. What's really kind of been the determining factor is price per unit. A lot of these value add opportunities have been snapped up. So buyers are having to pay more per unit than they were, say, a couple of years ago, and that's really kind of changed things. When you're having to, let's say in Texas, buy a property for what you could have got for $33,000 a door for a Class C, now we're seeing people pay $35,000, $36,000, and sometimes a little bit more per door. So that's really what we're seeing as far as having a bigger impact on things, just the amount of that they're paying for a property versus a couple of years ago.
Got it. Speaking of marketplace, opportunities for investors. You mentioned tier 1, 2, 3 kind of thing, and where you're seeing. Are there any areas of the country where you're seeing where you continue to see opportunities that haven't yet been fully exposed or taken advantage of?
No. It's things have really changed quickly over the past couple of years. Just from, like I said, as far as buyers being able to buy properties at a lower price point and really kind of have an easier time with a value add opportunity. Now, what we're seeing as far as value add is switched more from, say, rehab and creating equity that way to now properties that there may be an older operator involved, somebody that bought a property a couple years ago and didn't really do well with it, so it's just been grossly mismanaged. So that's what we're seeing. A lot of the people now is going from the rehab sort of value add to now bringing in better management, cost cutting, implementing cost cutting procedures. So, but as far as markets go, Texas has been the darling state of a lot of investors. It's been, I want to say, picked over pretty well. I think a lot of the wannabes have been flushed out, and the experienced investment groups, they're all fighting for the same properties. So it's a matter of being able to execute quick, put the property under contract, and in a lot of cases they're paying top dollar, meaning they're paying the asking price and sometimes a little bit more. But Florida is a state that I think is, I don't want to say if it's up and coming. I don't really do enough to really say if, all I can really say is that, in the South, you have a lot of foreign money coming in from South America that are buying properties there. They'll pay top dollar, but generally speaking, properties command more money in the Miami area than say up north around Daytona, Florida, Orlando, Tallahassee, Jacksonville. But I think there's some opportunities there as Florida's recovered. I've seen property values increase, and I'm seeing more requests come from those northern cities in Florida. And Atlanta is a good city as well. We have quite a few investors that operate out of Atlanta. It's a good market, and I think I've seen some more investment activity there from groups that haven't previously been looking for properties there.
Kind of move on here just a little bit. Multifamily has been kind of the bull, if you will, for the last several years as far as where new construction and sure. I guess it kind of goes with the fact that everybody needs a house, and there were so many people displaced with the crash, and multifamily was basically an opportunity for the displaced to land, and also for the investors to take advantage of. Do you see any kind of opportunities moving, or do you see the market, or are you exposed to opportunities in other commercial properties such as office, retail, assisted living? Is there anything like that you see emerging, or do you play in that arena, or any other?
Yeah, there's more activity in the retail side. Some office. But that's generally it. You mentioned assisted living. That's a very niche operating space as far as being able to obtain financing there. You got to have the experience to own and operate one of those facilities. They can certainly be cash cows, but as far as an investor, if you don't come from that space, it's really hard to break into it and obtain financing that's worth anything. But retail, we do finance quite a bit of retail as well, and it's something that I don't know if it's new activity, but certainly it's something we are experiencing for our part. Foreign investors, but also just domestic investors. Again, trying to use syndications to raise the money. But the capital markets are more relaxed when it comes to retail properties. There's some value add opportunities in that as well. On the Class C side, so that's something that works well, as well as self storage. It's not really something I think a lot of people think of, and certainly self storage facilities can run the gamut from your small mom and pop ones to your large new construction with temperature controlled units and whatnot. But that's another asset class where some investment activity is taking place in, and to some degree mobile home parks. But I think there's always going to be activity in some of these spaces. Just people want to or realize opportunities, or that's just their focus. But by and large, multifamily is still where most people are trying to focus their dollars.
Got it. I'm looking just as a couple of things before we close up here. Maybe a good one to just kind of touch on is if somebody is looking to do a refinance, or maybe a purchase, maybe they've been in other properties, but now they're wanting to try and step up their game or move into something. Is there any kind of a roadmap you could provide for somebody to either buy or refinance? What they would need for consideration if they were looking to to refinance or buy, I guess. If that's an easy roadmap you can describe.
it really starts out with having a goal and focus. There's a lot of opportunities out there as far as options. So one thing that we do a lot of is trying to structure a loan properly and based on the goals. What's your ultimate goal here? And it really comes down to how long are you going to own the property for. So where we have the ability to do, say, mini perm financing anywhere from 2 to 5 years for somebody that's not really, they don't plan on owning it for any longer, then getting a 10-year loan doesn't make any sense because you're going to have a prepayment penalty. Yield maintenance is still a popular choice, and that could, while rates are expected to increase, yield maintenance can really hurt you as far as trying to get out of that property for the long haul. So if you have a 10-year loan, you're kind of stuck with that property. Even on a step-down prepayment penalty, you're going to be paying a heavy prepayment penalty. So, having a really good grasp on what your goals are and what you're going to do with the property. So, if you're in a value-add scenario and you're going to create equity, maybe a short-term loan makes sense so that you can cash out some of that equity later on versus lock it up in a long-term loan. So I think it's really important to really have good understanding as far as what your business model is so you can get the appropriate loan. Getting a good loan doesn't make, with a good rate doesn't make any sense, doesn't help you if you're stuck with it and you get all kinds of equity that's going to be trapped and benefits the lender but not you. So first and foremost is knowing what programs are available. We use the adage all the time, square peg, square hole. You got to just put the right loan with the right lender, the best lender. So that's it. And as far as the first step, and then it's just a matter of as far as the financing end of it goes. You got to have two big things that really kind of we focus on are pro forma. This is not necessarily for a stabilized property that you're just looking to do a rate and term on. Doesn't matter so much, but for almost any other property, having a good pro forma, especially if it's a story-based loan that shows realistically, and by that I mean using market data, market expenses, market rents, absorption, to accurately project the income of the property so that a lender can really have a good understanding as to where this property's potential is key. As far as a good year-to-date financials and income and expense statements. I say that because a lot of people, whether it's due to lack of experience or whatever the case may be, they just don't have good financials that they can present to a lender and can really start things off on a negative foot. So those are really kind of the critical things. I mean, everything else is kind of a given, meaning as far as property management, the experience, your liquidity, your financials. If you don't have those, then we're not really going to go anywhere. Sometimes you can mitigate that by raising funds and whatnot, but every lender wants experience. They want to see a good, strong borrower. They want to see good property management, and as far as everything else goes, you gotta spoon feed it to the lender, and having a good pro forma, good income and expense statements, profit and loss. It really behooves you to do that. Put the time and do those well.
Got it. We're about out of time, but before we close, I wanted to give you a chance without giving a commercial. Tell us what a great opportunity, kind of your sweet spot is, and then the best way to contact you.
Yeah, so I mean, in short here, I know we kind of went over a lot. It's my first podcast, so hopefully it wasn't boring. But we focus on relationship lending, and we believe that in the lending community, having working with somebody that has good relationships is key. It all boils down to, like I said just a few minutes ago, placing the loan with the best lender, and that I can't stress enough how important that is, so that you can obtain all that you want, not just part of what you want, but all that you want, or as much of what you want as possible. So we're relationship driven. Everybody we work with, we have known for years, and we have made it an effort to try and work with the best people at that lender that's possible, which in a lot of cases that translates into benefit to the borrower versus you going in cold and just working with the first person you meet there or calling them up on the phone and who are you actually working with and you have no idea. So that's what's important for us. Our sweet spot is our loans that don't necessarily fit a bank. That's probably the easiest way to say it. We have relationships with CMBS lenders. That's predominantly who we use. So what we can do here is a lot of financing that a bank can't do. And as far as what that really translates into, it's non-recourse financing, cash-out financing, financing for people that use syndications, and value-add, short-term and bridge financing for deferred maintenance or repairs. That's it.
Got it.
Mostly it.
Well, yeah, but I think there's a lot of room in there, and it sounds like, again, what you commented in the very beginning is the relationship.
Yeah.
Your relationship allows you to do more of the story-based lending, which I think that's definitely a value for anybody looking to invest or needing money. What's the best way for somebody to contact you, Darryl?
Sure. I try to make myself available. I am somebody that strives to make communication something that is a strong suit here. So my phone number is 207-703-0397, and my email is Darryl, which is DARRYL, at glblsolutions.com.
All right. Well, Darryl Dahlen, it's been great talking with you today, and I really, really appreciate you taking the time to do so. And hopefully we'll do it again soon.
It's been my pleasure. Thanks for having me.
All right, you bet. And for our listeners, remember you can find us, Commercial Real Estate Pro Network. You can Google and find us on Facebook, YouTube, LinkedIn. If you're on LinkedIn, look us up. Join the group, Commercial Real Estate Pro Network. We're on Twitter at CRE Pro Network and commercialrealestatepronetwork.com. Please like, follow, share, comment. We'd love to hear from you. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.